The financial world is collapsing again. As we speak, the next bubble is about to burst, and we are all going to pay the price for it. The signs are everywhere, and yet people are still not paying attention. The last time this happened was in 2008, and it was a disaster. But this time, it's different. It's worse. How do we know there's a bubble? Trust me, there is. Just call Bennett and buy 50 million swaps on the MBS. Michael Burry wasn't the only one in 2007 who saw that a housing collapse was coming. Steve Eisman, depicted by Steve Carell in Paramount Pictures' The Big Short, also made an enormous amount of money betting against the banking sector. And today, Eisman is back on CNBC, providing a frightening outlook on the unfolding financial crisis that began last week with Silicon Valley Bank. But this is just the beginning. This week, Credit Suisse, an investment bank with over $500 billion of assets, is on the brink of collapse. And while it seems like the bank would be considered too big to fail, what if it's actually too big to save? The truth is that we are all in big trouble, and we need to be prepared for the worst. But, before we get started, are you worried about the status of the American economy? Do you want to stay ahead of the curve and make informed decisions? Look no further than Market Meltdown TV. Our channel provides expert analysis, up-to-date news, and practical tips to help you navigate the upcoming recession or even worse, depression. Don't miss out on our latest content and help us spread the truth to our nation by hitting the subscribe button, giving us a thumbs up, and sharing with your fellow Americans to join the Market Meltdown TV community today. Many people are comparing the banking crisis we see today to what happened in 2008, but besides both of them happening within the financial sector, the situations are completely different. As Warren Buffett says, when the tide goes out, you see who's naked. This is a different tide. This is not a credit tide. The credit quality of the United States is really good. This is a tide of a mistake. The failure of Silicon Valley Bank, Signature Bank, and now potentially Credit Suisse has absolutely nothing to do with the quality of their credit. These banks aren't failing because they thought they had billions of dollars worth of assets that are now worthless. Rather, it's the types of assets they actually chose to invest in. Some of the regional banks, especially those that have a lot of deposits above 250, have long-term bonds at very, very low levels and have massive mark-to-market losses. That's why Silicon Valley failed. Also, they failed because they had a very, very concentrated type of deposit base which has a very big herd mentality. Silicon Valley Bank chose to invest a large portion of its deposits into long-term treasury bonds when interest rates were very low, which, by the way, is pretty much fine in any circumstance except one where there is a rapid increase in interest rates, which is, of course, what has happened over the past 12 months. All of a sudden, these looking US Treasury bonds needed to be sold well before maturity at a steep discount. Silicon Valley Bank wasn't included in the banking stress test that occurred last year, but even if they were, it's likely that their problem would have still been missed. The stress test for last year had about a line in it about rising rates, and the rest of the entire stress test was about credit. So even if Silicon Valley had been in the stress test, given what the stress test says, I don't think the regulators would have caught it. With these new interest rate issues now exposed to the world, is it at all possible that the issues that regional banks are facing could flow into major national banks like Bank of America or JP Morgan? Eisman believes that the large US banks are not in the same position as some of the regional banks, so the risk of bigger banks failing is relatively small. But that doesn't mean that there won't be any more pain in the financial sector before the dust settles. The European banks, while they're not as well capitalized, but what if Credit Suisse is actually too big to be saved in this case? Eisman points out that the bank has over $500 billion in assets, which is a significant amount of money even for a government bailout. He notes that there are other factors to consider as well, such as the fact that Switzerland is a relatively small country with a limited capacity for government bailouts. If you look at Credit Suisse, it's a big bank in a small country, he says. Switzerland can't bail out Credit Suisse like the US government could bail out Citibank or Bank of America. Eisman also points out that the situation with Credit Suisse is not an isolated incident. He believes that there are other banks out there that are similarly exposed to risk and that could fail in the coming weeks and months. He notes that the banking sector is highly interconnected, and that one failure can easily lead to another. The problem with the banking system is that everything is connected, he says. If one bank fails, it can cause a domino effect throughout the entire system. Given the current state of the banking sector, Eisman believes that investors need to be very careful about where they put their money. He advises against investing in regional banks or any other banks that are heavily exposed to interest rate risk. He also warns against investing in any companies that are highly leveraged or have a lot of debt. Investors need to be very selective right now, he says. They need to look for companies that are well capitalized, have strong balance sheets, and are not overly exposed to risk. And they need to be prepared for more pain in the financial sector before things get better. In conclusion, Eisman's outlook on the current state of the banking sector is highly pessimistic. He believes that the situation with Credit Suisse is just the tip of the iceberg and that there are other banks out there that are similarly exposed to risk. He warns investors to be very careful about where they put their money and to look for companies that are well capitalized and not overly exposed to risk. While his views may be bleak, they are a sobering reminder that the financial sector is a highly complex and interconnected system that is always at risk of collapse. Thanks for tuning in to Market Meltdown TV. We hope our expert analysis, news updates, and practical tips have helped you stay ahead of the curve in today's volatile market. The mainstream media will never want you to stay informed, so if you found this video helpful, please hit the like button, subscribe to our channel, and share it with your friends and fellow Americans. Your support helps us bring you even more valuable content. Remember to hit the bell icon to get notified when we release new videos. Thanks again for watching, and we'll see you in the next one.